Have you ever wondered how an ordinary person can consistently beat Wall Street's smartest professionals at their own game? What if I told you that some of the greatest investment opportunities are hiding in plain sight, right in your local shopping mall or grocery store? Today we're diving deep into Peter Lynch's legendary investment masterpiece that turned conventional wisdom upside down and showed millions of everyday investors how to achieve extraordinary returns. Peter Lynch didn't just talk the talk when it came to investing success. As the manager of Fidelity's Magellan Fund from 1977 to 1990, he delivered average annual returns of 29%, turning a $10,000 investment into over $280,000. But here's what makes Lynch truly remarkable. He believed that amateur investors actually have significant advantages over professional fund managers, and he proved it by using simple, common sense strategies that anyone can master. 1. Up on Wall Street isn't just another dry investment manual filled with complex formulas and insider jargon. It's a revolutionary approach that empowers regular people to make informed investment decisions using their everyday experiences and observations. Lynch argues that the best investment ideas often come from your daily life. The restaurants you love, the products you can't live without, and the companies whose services you use regularly. What makes this book absolutely fascinating is Lynch's ability to demystify the investment world while sharing real stories from his decades of experience managing billions of dollars. He doesn't promise get-rich-quick schemes or magical formulas. Instead, he offers a systematic approach based on thorough research, patience, and understanding businesses at their fundamental level. Throughout this comprehensive summary, we'll explore Lynch's groundbreaking strategies that helped him achieve legendary status on Wall Street. We'll uncover the specific techniques he used to identify winning stocks before they became household names, and discover how you can apply these same principles to build your own successful investment portfolio. Get ready to transform your understanding of investing forever. The foundation of Lynch's investment philosophy rests on a surprisingly simple premise that challenges everything Wall Street wants you to believe. While professional investors spend countless hours analyzing complex financial models and following sophisticated algorithms, Lynch discovered that the most profitable opportunities often reveal themselves through basic observation and common sense reasoning. Lynch categorizes all stocks into 6 distinct types, each requiring different analytical approaches and investment timelines. Slow growers represent large, mature companies with limited expansion potential but steady dividend payments. Stalwarts are well-established companies growing moderately faster than the economy, offering consistent returns with lower risk. Fast growers are smaller companies experiencing rapid expansion, potentially delivering exceptional returns but carrying higher volatility. Cyclicals follow predictable patterns tied to economic cycles, requiring precise timing for maximum profitability. Turnarounds are troubled companies with potential for dramatic recovery, offering high rewards for investors willing to accept substantial risks. Asset plays involve companies whose true value lies in undervalued real estate, natural resources, or other tangible assets rather than their current business operations. The book extensively explores Lynch's research methodology, emphasizing the importance of understanding a company's business model, competitive advantages, financial health, and growth prospects. He advocates visiting stores, talking to employees, analyzing quarterly reports, and maintaining detailed records of your investment reasoning and performance tracking. Lynch shares numerous real-world examples from his Magellan Fund experience, including his early investments in companies like Dunkin' Donuts, Stop and Shop, and Taco Bell. These stories illustrate how careful observation of consumer trends and business fundamentals led to extraordinary investment returns that professional analysts initially overlooked. The narrative also addresses common psychological pitfalls that destroy investment performance, including emotional decision-making, following hot tips without research, and the dangerous tendency to sell winners too early while holding losing positions too long. Lynch provides practical strategies for maintaining discipline during market volatility and avoiding the herd mentality that drives most investors toward mediocre results. Perhaps most importantly, Lynch emphasizes that successful investing requires patience, continuous learning, and the willingness to admit mistakes while learning from them. He argues that individual investors who do their homework can achieve superior results compared to professional fund managers who face institutional constraints and pressure for short-term performance. Lynch's first fundamental principle centers on investing in what you know and understand thoroughly. He argues that your everyday experiences as a consumer provide invaluable insights that Wall Street professionals often miss completely. When you discover a restaurant with consistently long lines, a retailer with innovative products or a service that solves real problems, you're witnessing potential investment opportunities in their earlier stages. The second major concept involves understanding the critical difference between a good company and a good investment. A company might have excellent products and strong management, but if the stock price already reflects all positive expectations, it may not generate superior returns. Conversely, a temporarily troubled company with solid fundamentals might offer exceptional value if purchased at the right price. Lynch's third principle emphasizes the importance of thorough research and due diligence. He advocates reading annual reports, understanding financial statements, and analyzing key metrics like debt levels, earnings growth, and competitive positioning. This research should focus on understanding the business rather than trying to predict short-term stock price movements. The fourth key insight involves proper portfolio diversification and position sizing. Lynch recommends owning stocks across different industries and company types while avoiding over-concentration in any single position. He suggests starting with smaller positions and increasing them as your conviction grows through continued research and positive business developments. Lynch's fifth principle addresses the critical importance of timing and patience in investment success. He argues that the stock market serves as a voting machine in the short term, but functions as a weighing machine over longer periods. This means that superior companies will eventually be recognized by the market, but this process often takes years rather than months. The sixth major concept focuses on understanding market cycles and investor psychology. Lynch explains how fear and greed drive market extremes, creating opportunities for disciplined investors who can remain rational during periods of widespread panic or euphoria. He provides specific strategies for taking advantage of these psychological cycles. Lynch's seventh principle involves knowing when to sell investments. He outlines specific criteria for selling stocks, including fundamental deterioration of the underlying business, achievement of your original price target, or discovery of better investment opportunities. He emphasizes that selling decisions are often more difficult than buying decisions. The eighth key insight addresses the importance of learning from both successful and unsuccessful investments. Lynch advocates keeping detailed records of your investment reasoning and regularly reviewing your decisions to identify patterns and improve your analytical process over time. The first crucial takeaway from Lynch's approach is that individual investors possess significant structural advantages over institutional fund managers. You don't face quarterly performance pressure, regulatory restrictions, or requirements to maintain specific portfolio allocations. This freedom allows you to hold investments for optimal time periods and take advantage of opportunities that institutions cannot pursue. Developing your circle of competence represents the second essential lesson. Focus your investment research on industries and companies you understand well through personal or professional experience. This knowledge advantage helps you identify important changes before they become apparent to the broader investment community. The third key principle involves recognizing that extensive research and preparation are absolutely essential for investment success. Lynch emphasizes reading company annual reports, understanding business models, analyzing competitive positions, and staying informed about industry trends. This homework separates successful investors from those who rely on tips and speculation. Understanding the relationship between growth and valuation forms the fourth critical takeaway. High-growth companies deserve premium valuations, but even the best companies can become overpriced. Lynch provides specific metrics and ratios for evaluating whether a stock's price appropriately reflects its growth prospects and business quality. The fifth important lesson focuses on the power of patience and long-term thinking. Lynch's greatest investment successes often required years to fully develop, and he emphasizes that the stock market rewards patient investors who allow superior companies time to compound their business success into stock price appreciation. Managing your emotions and psychological biases represents the sixth essential skill. Lynch explains how fear, greed, and social pressure influence investment decisions in counterproductive ways. He provides practical strategies for maintaining objectivity and discipline during periods of market volatility and uncertainty. The seventh key takeaway involves understanding when to cut losses and when to hold losing positions. Not every investment will succeed, and recognizing deteriorating business fundamentals early can prevent small losses from becoming major portfolio disasters. However, temporary stock price declines don't necessarily indicate business problems. Learning to think independently and avoid following crowd psychology forms the eighth crucial principle. Lynch argues that the most profitable investment opportunities often appear when popular opinion is overwhelmingly negative about specific companies or entire industry sectors. The ninth essential lesson emphasizes the importance of diversification while avoiding over-diversification. Lynch recommends owning enough different stocks to reduce company-specific risks while maintaining concentrated positions in your highest conviction ideas. The 10th and final key takeaway focuses on continuous learning and adaptation. Markets evolve constantly, and successful investors must stay curious, admit their mistakes, and refine their approaches based on new experiences and changing market conditions. Peter Lynch's One After One Up on Wall Street stands as one of the most influential investment books ever written, not because it promises easy riches or magical formulas, but because it empowers ordinary people with practical wisdom and actionable strategies. Lynch's central message resonates as powerfully today as it did when first published, that careful observation, thorough research, and patient execution can lead to extraordinary investment success. The book's enduring value lies in its democratic approach to wealth building through equity investing. Lynch demonstrates that you don't need advanced degrees, insider connections, or sophisticated computer models to achieve superior returns. Instead, success comes from understanding businesses, recognizing value, and having the conviction to act on your analysis when others are paralyzed by uncertainty or following the crowd. Perhaps most importantly, Lynch's approach emphasizes that investing should be viewed as business ownership rather than speculation or gambling. When you purchase shares in a company, you become a partial owner of that business, entitled to your proportional share of its future success. This ownership mentality encourages the kind of long-term thinking and careful analysis that leads to sustainable wealth creation. The book also serves as a powerful reminder that market volatility, while emotionally challenging, creates opportunities for prepared investors. Lynch's experiences during various market crashes and recoveries illustrate how temporary price declines in quality companies often represent some of the best buying opportunities for patient investors with available capital. For anyone serious about building long-term wealth through equity investing, One Up on Wall Street provides both the philosophical framework and practical tools necessary for success. Lynch's legacy continues inspiring new generations of investors who understand that with proper preparation, discipline, and patience, achieving financial independence through stock market investing remains not only possible but probable for those willing to do the work required.